Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Thursday, September 1st. It's about 12:15 on the West Coast, and since I last talked to you guys, the markets have taken a bit of a downturn. Going back to last Thursday, I mentioned on the video that the next day, Friday, was going to be a huge day with inflation numbers coming out, and then Jerome Powell scheduled to speak at Jackson Hole, the economic symposium. So we got the inflation data in the morning, and that came out about as expected. Inflation dropped, I believe, from about 6.8 to 6.3, and so that was about what was in line with expected. So that wasn't incredible news, but it was good enough news. But then Jerome Powell took the stage and gave a pretty quick talk. But in that talk, he really spooked the markets and had a big negative effect. So one quote I want to share with you guys real quick here. So this kind of sums up, basically his message over the 8-minute talk he gave was, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. So, to sum that up, that's going from, before their message was a soft landing, and now he's talking about pain. So soft landings don't cause pain. Hard landings cause pain. Anybody that's fallen down knows that. So basically what they're saying, he's saying here is that, they're kind of going back on what they were thinking before, that hopefully they were going to be able to thread the needle, be able to avoid recession, and get inflation under control. Basically what he's saying is that, to get inflation under control, it's going to cause some pain for us in the economy, whether it's, in households with jobs going away, stuff like that. So that direct talk that he gave had a big negative effect on the markets. The Dow dropped about 1,000 points that day and is down about 2,000 points since. And then mortgage rates in the bond markets. That morning before he spoke, the average conventional 30-year fixed rate, according to a lender survey across the country, was about 5.73%. This morning we're at 6.23%. So in less than a week after that came out, we have about a half a point increase, which obviously is not a good thing. And then going back, it's actually gone above the peak in mid-June. Mid-June, we're about 6.15 is where we maxed out at. And now, like I said, this morning, we're at 6.23. And today is not going too great either. So it might get worse before it gets better. So what does that all mean? Obviously, lenders should be paying attention to all this. If they have clients close to closing, clients in the process, definitely lenders should be on top of this. And then in the long run, until the bond market feels that inflation is under control, we're going to see rates stay at an elevated rate, either go a little bit higher or stay where they're at. When we see inflation start to come down, like we've talked about before, that's when we should see an improvement in rates. And based on Powell's talk, it doesn't sound like it's going to be as easy as they expected. So this talk of pain means maybe, hey, this is going to take a little bit longer than expected. So maybe that takes, inflation a little bit longer to get under control, and then that will pass over to mortgage rates. So besides that, one other effect that could have on the rates in the short term, more on the short term, is job numbers. So job numbers come out tomorrow from the BLS. If those come in higher than expected, so more job growth than expected, that will be bad for rates. We could see them spike even higher. If those job numbers come in a little bit lower, which ADP came in a little bit lower, that's not a guarantee that BLS will, but ADP came in lower than expected. So if BLS comes in lower than expected, we might see some positive movement in rates with them, going down. Besides that, I also wanted to share with you guys, we got two different sets of appreciation data this week. So we got the Case-Shiller, which shows, year over year down from 19.9% to about 18%. And then we also got the FHFA, which showed it going from 18.3% year over year to 16.2%. Keep in mind, this is June data, so it's a little dated. So definitely appreciation is slowing down, but keep in mind that deceleration is not the same thing as a decline. So we're still at a historical levels of appreciation. In fact, in the last 35 years, if you went back, only 4 times have we in a full year have gone above 10.6% appreciation growth. And according to the current numbers, the composite national composite, we're at 10.6% for 6 months. So still healthy appreciation equity, for current homeowners, but definitely slowing compared to where it was. which is to be expected with the different things in the market, house sales slowing, prices being reduced, and things like that. So let me open this up here. So besides that, I didn't really have much for you guys. Like I said, with the markets in such volatility, lenders really should be paying attention to that. So if you yourself or if you have clients that are in the loan process, make sure your lender is paying attention to everything that's going on, because a half a point jump in a week is a big difference in some payments, and that could be the difference between qualifying and not qualifying. So it really benefits everybody if the lender's on top of it. If you are working with someone, or if you've worked with someone in the past that is not on top of that thing, feel free to reach out to me, and I'd be more than happy to help you guys as always. Have a great day, and I'll talk to you guys soon. Thanks a lot.